Welcome to our first module on analyzing and recording economic events related to inventory. The economic events that we'll be studying in this module all relate to acquisition of inventory from the supplier. We'll first start with looking at purchasing inventory, receiving discounts, paying for shipping, returning inventory, and then making a payment to the supplier. All of these things have to do with interactions between the economic entity and the supplier. We'll start with purchasing inventory from the supplier. We have an example where on June 3rd of year one, Acme Fireworks purchased 1,000 bundles of fireworks from It's a Blast Inc. The list price for each bundle is $3.30. The shipping cost is $100. Acme received a 10% quantity discount, and the payment terms are $210 and $30. There are a lot of things going on with this transaction, but we're going to take it one step at a time. The first thing we want to do with any economic event is analyze the transaction. We know that inventory is coming into Acme Fireworks and that inventory is an asset because it provides future economic benefit. It's something that we own with the purpose of selling to our customers. So we're going to increase our inventory account by debiting inventory for some amount that we'll determine later. We're also promising to pay for this inventory later. We have an obligation to pay in the future, which means we have a liability that's increasing. So we're going to credit accounts payable. Now that we've determined the nature of the journal entry, debit inventory to record the inventory coming in, credit accounts payable to reflect that we have an obligation to pay in the future, we can now take a closer look at the amount this journal entry needs to be recorded for. Well, we know that we purchased 1,000 bundles and the list price for each bundle is $3.30. So our purchase price is $3,300 without taking other things into consideration. We have shipping charges of $100, so that brings our purchase price up to $3,400 because when we for shipping from the supplier, it becomes part of the cost of the inventory. We're also receiving a 10% quantity discount. That discount will reduce our purchase price, and that brings us down to $3,060. Our discount is $340. $340 subtracted from our purchase price of $3,400 gets us to an adjusted purchase price of $3,060. The last thing to take into consideration are the payment terms. The payment terms are $210 and $30. What this means is that we have a % discount available for a certain number of days. The first number tells us our % discount, in this case 2. The second number tells us the days of the discount is available, in this case 10. So we have a 2% discount available for 10 days. After the comma, it tells us the terms or the amount due after the discount ends and the due date. So in this case, the net amount is due in 30 days. Assuming that we take advantage of the discount, or at least record the transaction as if we will take advantage of the discount, we take 2% of our adjusted price, which gets us to $61. So our net price after taking shipping and the discounts into consideration is $2,999. So using the net method, we are going to record the purchase by debiting inventory for $2,999 and crediting accounts payable for $2,999. The only thing that would differ if we were not using the net method, the alternative to the net method is the gross method, which we'll discuss at the end of this module, would be that we would not take the discount into consideration. We would record the transaction before the early payment discount. Sometimes early payment discount is also called a cash discount. We would still take into consideration the quantity discount as well as the shipping charge. Again, the difference between gross and net is that net subtracts out the early payment or the cash discount before recording the inventory acquisition. The gross method does not take out the $61 or the early payment or cash discount before recording the transaction. The next thing we're going to do is return 20% of the fireworks to the supplier. That means inventory is going out of Acme. If inventory is going out, we need to reduce the asset, and we reduce the asset by crediting inventory. If we're reducing the inventory, our obligation to pay is also going down, so we have a liability that's decreasing. So we're going to debit accounts payable to reflect the decrease in the liability that results because we're returning inventory. So the journal entry is the opposite of what we did when we purchased inventory. Now that we understand the journal entry we need to make, let's look at how we determine the amount. The total cost for 1,000 bundles was $2,999. 20% of that inventory was returned, so we're returning $600 worth of inventory. We're rounding to the nearest dollar in this example. So accounts payable is debited for $600 and inventory is credited for $600. The next thing we'll look at are the inventory and account payable T accounts that represent our ledger. We see the 1,000 units that we purchased for $2,999, the 200 units that we returned for $600, which leaves us 800 units in inventory for $2,399. The accounts payable is a mirror image of inventory, and it also shows that we owe our supplier $2,399 for the inventory that we purchased, less the inventory that we returned. We'll also notice here that we have 800 units with a total cost of $23.99, which means each unit cost 2.998 cents. Now let's look what happens when we pay our supplier. We have our accounts payable account with a balance of $2,399, and if we pay our supplier within 10 days, we get to take advantage of the cash discount, and we only have to pay $23.99. So we lower accounts payable by debiting accounts payable $23.99, and we lower cash by crediting cash $23.99. But what if we don't pay within 10 days? What if we pay after 10 days? If we pay after 10 days, then we have to pay an extra $49, which represents the lost discount on this unpaid balance. That means that we have to credit cash for $24.48, but we can only debit accounts payable for $23.99 because that's the balance that's in accounts payable related to this transaction. So we'll debit accounts payable $23.99, but we also need another debit of $49 for the discount. We're going to debit an account called discounts lost for the $49. Discounts lost represents an expense, and it's an expense because there's an extra charge associated with paying after the 10 days. The discounts lost is very similar to an additional charge for the privilege of paying late. Then we credit our cash account $2,448, which represents the amount that we owe the supplier if we're paying after 10 days. The next thing we want to look at is what would happen if instead of using the net method, we use the gross method. So here, we're going to reconstruct our accounts payable using the gross method and not the net method. Instead of recording the purchase at net, we'll record the purchase at gross, which means before the discount was taken. So our purchase would be recorded at $3,060. Our return would be recorded at $612, which is before the discount. So our balance in accounts payable would be $2,448 if we use the gross method. So if we pay within 10 days, however, we still only pay the $23.99. But since we recorded it using gross method, we have to debit accounts payable for $2,448, which is the balance in the accounts payable account. That means we need a credit of $49 that we'll put to discounts taken. Discounts taken is a contra expense account, which means it lowers our total expenses. So because we are paying before the discount period expires, our discounts are lower than what they would have otherwise been had we not paid in a timely manner. If we pay After 10 days, we'll pay the full $2,448, which means we debit accounts payable $2,448 and we credit cash $2,448. Now let's review. When we purchase inventory from the supplier, we increase inventory and accounts payable for the cost of inventory. When we receive a discount from the supplier, the discount reduces the cost of inventory and it reduces accounts payable. When we pay for shipping from the supplier, the shipping charges increases the cost of inventory as well as accounts payable. When we return inventory to the supplier, both inventory and accounts payable are reduced for the purchase price of the inventory. When we make a payment to the supplier, we will record more expense if the net method is used and the discount is not taken, and we will record less expense if the gross method is used and the discount is taken. The gross and net method are a little bit confusing and tricky. You'll want to take some time to review that section of the module again and then practice it with some of the exercises. So this wraps up our first section on economic events related to inventory. Our next module will look at economic events related to the sale of inventory.